Well, for more budget reaction now, including how the markets are likely to react to it this morning, let's bring in our business editor, Ross Greenwood from Canberra. Ross, at face value, Jim Chalmers is painting a pretty grim future for the next few years for Australian families.
Yeah, he certainly is. There's no doubt, Pete. And even what you heard Holly and those people in the street talking about is that there's a realisation in Australia now that times are going to get tougher. And the Treasurer has not sugarcoated that at all. And this is an unusual budget in some ways because it actually paints out a almost worst-case scenario. Now, normally budgets don't do that. There's the numbers. That's what you've got. That's what we think it's going to be, for better or worse. In this one, it actually sits out there and paints out a slightly different picture. And this is a good example of it. Here's the inflation forecast. The base case is for inflation to basically rise and peak to 7.75%. But in a worst case scenario, it says, look, it could get higher, out towards 9%. And that being the case, interest rates would stay higher for longer. The second part about this, Pete, is that we are going to see today the latest inflation numbers. The September quarter is out. And you can even see here from the June quarter to the September quarter, there's expected to be a rise from 6.1 to 7%. But the thing you've got to watch here is the so-called trim mean, or the underlying inflation. Now, if it does go to the forecast 5.6%, that will be the highest that underlying rate of inflation has been since 2003, when it was actually begun. And remember, that's the thing that the Reserve Bank wants. But as I say, there's a narrative, a story you can tell from this budget. Here's the Reserve Bank. It says in 2023, next year, that the cash rate will peak at 3.35%, taking people's mortgages above 5%. But that's in the market forecast, not the worst case scenario, where you could see the cash rate, if inflation stays higher, the cash rate and interest rate staying higher for longer. And so here you've got then potentially it running into unemployment. And the trick of this right now is for people to keep their jobs, because if, as expected, the unemployment rate does rise out to 4.5% from the current 3.5%, that would mean there's 140,000 Australians out there looking for work. And so it really is a situation in this budget where it's a pretty bleak sort of outlook for many Australians who recognise that tougher times are coming. But the reality is you'd prefer to have the soft landing, that the interest rates do the right thing, that the economy doesn't fall off a cliff. But certainly what is known right now is that there are some concerns that things could be a whole bunch worse in the future.
Well, I mean, looking at gas prices, as you know, Ross, I mean, folks are going to be looking at another $1,000, $2,000 next year when it comes to gas and electricity. Is it fair to say that the recently renegotiated domestic trigger was a fail?
Well, there's no doubt it was a fail. It was an absolute fail, because the point is also that while people are worried about their own home heating bills, think about another thing. Gas is one of the drivers of our industry. Now, if you want to make bricks, you've got to have gas. If you want to have a foundry, you've got to have gas. So the point is that the inputs for business are going to be higher. That's one reason why potentially there could be even higher unemployment if businesses are driven out of Australia or businesses close as a result of high energy prices. And that's the reason why this government needs to act, and act quickly, to try and save those jobs, to try and save the industry, that simply the higher energy prices just don't wipe them all out.
And just a final one here, the savings. The government very reluctant to admit that that's unlikely to happen, but the $275 savings, I mean, they're a gone burger, aren't they, Ross?
You'd have to think so. And the reality is that, it's either going to be a situation where the savings disappear, or at some point in time in the future, the government has to make a decision about those stage 3 tax cuts. Everybody's pushing them. They're sort of pushing back. And of course, they're out into the future. There's a few things they could do. They could tweak them, or they could push them out over until the next election and go to the election with a different tax plan. And that might very well be the route that Jim Chalmers and Anthony Albanese are forced to take.
What do you think about that? And I'll close here, Ross, because I know you got to go. But I mean, Chris Richardson, he was on the show early. He said, short answer, keep the 37% tax bracket. Well, is that an option for you, or do you think things should stay as they are? Because we might well need stimulus in 2024.
See, there's the funny thing about it. So here's the interesting thing. Yes, by the time you actually get to 2024, you could have interest rates coming down because Australia could have been close to a recession. Now, one of the things in the forecasts actually show that Australia in 23-24 will go close to a recession. That's the time when the economic pain is going to be greater. So that's also the time when interest rates will be coming down from these highs. And so that's also the time when government steps in, generally with some stimulus of its own, and that could be tax cuts. So my suggestion is they should actually keep that plan to scrap that 37 cents in the dollar tax cut. You could trim it back from $200,000 as a maximum to $180,000, and that will save less, but certainly be another change.
Okay, little tweak there. Ross Greenwood, as always, thank you, Ross. We'll talk to you later on in the week.